Hey, my name is Alex McGowan with McGowan Tax. Today we're going to be reacting to some videos that are talking about specific international tax situations, either to say where they're wrong or expand on something that I think that they're saying is correct. Thanks for sending these videos. Keep it up. I'll react to them, give you my opinion on what they said right, what they said wrong, and what you need to look out for in videos like this so that you're getting the right international tax advice.
The U.S. government will literally pay you $25,000 to leave the country for the better part of a year. Let me explain. So it's called the Foreign Earned Income Exclusion. And what it means is if you spend 330 days or more outside the U.S., you do not have to pay federal income tax as long as you can show your income is coming from outside the country or working remotely, for example. Any rich person will tell you the biggest expense they have is taxes, so you're going to want to get good at avoiding those things as fast as possible in a legal way. And the exclusion includes over $100,000 in income, meaning you can save over 25 grand simply by living in another place. All you have to do is search Foreign Earned Income Exclusion. It'll pop up. You're welcome.
Just spending less than 30 days in the US does not automatically qualify for the Foreign Earned Income Exclusion, particularly when you're talking about people that are working remotely, the digital nomad types. There's some hurdles we got to jump through before you can just claim that Foreign Earned Income Exclusion. You have to have a tax home outside the US. You can't have an abode in the US. And then you get to that 330 day out of a 365 day period rule. So he's right. The Foreign Earned Income Exclusion, if you're moving outside the US, it's a very powerful tool and you should definitely not take it for granted. What I do with my clients is on the front end, we're building a case to make sure that you do qualify for this Foreign Earned Income Exclusion and you can support it. If you just assume you qualify for it, you may be missing a step that you could have very easily taken care of if you'd have done it in advance. For example, if all you needed to do was set up a gym membership and open a bank account in this foreign jurisdiction just to tip those scales over to moving your abode from the US to the foreign jurisdiction, but you didn't do that because you assumed, oh, I spent more than 330 days outside the US, so I automatically qualify. That's $20,000 in taxes you very easily could have avoided, and now you have a problem with the IRS, back taxes, penalties, and that sort of thing. So like anything with the IRS, it's not always quite as simple as it seems. This is a very powerful tool, but just make sure you do your legwork on the front end because it's going to pay you dividends year after year, and in particular, if you were challenged by the IRS, you just want to be in a position to where you can hand them a piece of paper and say, here's why I qualify, and they go away. At McGowan Tax, that's what we do. We help our clients save taxes, but also provide the supporting documentation to make sure the positions that we're taking are actually reasonable and defendable and defensible if the IRS comes asking questions.
The IRS is upping the Foreign Earned Income Exclusion amount. Last year, it was at $120,000 per taxpayer. Now this year, they just upped it to $130,000 per taxpayer, which means that if you're in a couple, then you have up to $260,000. Now, what does this actually mean? Essentially, you're able to earn up to $130,000 as an individual, only have to pay the country that you're living in, their taxes, what they're going to tax you. Now, if you earn over $130,000, you will have to pay the US government.
In this video, she's correct, but I think it's kind of funny how surprised she is with the increase in the Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion is indexed to inflation. So every year, you're going to have an increase in that Foreign Earned Income Exclusion amount. The amount it increases just depends on the consumer price index of that year. And the other thing is where she mentioned if you're filing as a couple, so a married filing joint return, that you get twice that amount. So instead of $130,000, it's $260,000. I just want to clarify that point a little bit because it doesn't mean you get twice that amount. It means each of you get that amount. So for example, and this is a common question I get from clients, is if one person is working and they both move abroad, the Foreign Earned Income Exclusion for that person that's working does not jump to $260,000. That person's exclusion amount is still $130,000. The other spouse is just eligible for their own $130,000 exclusion, but they have to be working and earn that income in order to take advantage of it. So one of the common strategies I employ is particularly with people that have their own businesses is in that case, it may make sense to start paying your spouse a salary or for the spouse to start working specifically for the business because now you're getting an expense at the business side that you can deduct as an exclusion up to $130,000. So as an example, if you were both in the US and this this company makes $300,000 a year, you're taxed on $300,000. If you move abroad, you can now pay each other a salary of $130,000 each, exclude the whole amount, and then you have, only $40,000 left. Only $40,000 is taxable of that amount because of the two foreign earned income exclusions. So I just wanted to point out those two differences. It's always indexed for inflation, and the foreign earned income exclusion is specific to the individual. You don't get twice the exclusion just by filing jointly. So this video is funny to me because he's obviously very frustrated and confused by the US tax system, which is very common for non-US people because the IRS tends to make things a little bit more complicated than most countries do from a tax perspective. But a lot of times with students, it's really not that complicated because if you come here on a student visa, generally an F visa, you get an exemption from having to be a US tax resident. So specifically, you get a 5-year exemption from having to count your days in the US for purposes of the substantial presence test. So you still get to file as a non-resident of the US. So you have to pick up your US source income. So if you're doing work in the US, you're going to have to report that. But if you're just here in the US on an F visa studying and you're in school and you're not earning income physically in the US, or maybe you even have passive income outside the US, that's not US source income. You're not going to have to report that. So it's really not that complicated in most situations to make sure that you're filing your tax return correctly. But just don't forget about the exemption. Don't accidentally or unintentionally file a regular resident tax return and start reporting worldwide income. It's not necessary. Use the exemption of days for that first 5 year and things stay pretty simple.
If you're an international student, it's so hard to get a job. There's one thing that we can take advantage of. We are FICA tax exempt. FICA tax is Social Security and Medicare tax that US citizens pay, and it's a big chunk of your paycheck, 8%. But the thing is, your employer, the person who is paying you, might not be aware that you are FICA tax exempt.
So this is actually a really good point. If you come to the US and you're a student on an F visa, there's exemptions to having to report your worldwide income as a resident. But if you're here and actually working in the US and employed by a company as part of your student visa, maybe you're on an internship, you still have to report that income to the IRS. But she's right in that you're not subject to Social Security and FICA taxes, which could save you 15% more or less on your income, which is a great deal. One thing to be aware of is that rolls off after 5 years in most cases. So if you're here on an F visa, you can exempt your days from the substantial presence test so that you're not considered a US tax resident, you don't file a 1040, and you don't have to pay FICA and withholding taxes. You need to let your employer know that you're still considered a non-resident so that they're not withholding Social Security and Medicare. But once you roll off of that, if you stay in the US, now they do have to start withholding FICA and Medicare. And I had a specific case with a client where they rolled off with the same company, and the same company even sponsored their green card, and they got a green card in the US, but they never started withholding FICA and Medicare again. So 3 or I think even 5 years went by where this person was a green card holder, receiving a W-2, working and living in the US, and they were not withholding FICA and Medicare. And it caused a big problem, right? Because now this person hasn't contributed anything to the social systems that they wanted and intended to. And the employer is at risk because they had a technical requirement to withhold that FICA and Medicare. So that created a big problem between the employer and the employee that we had to work out. And really it turned out where there's a potential lawsuit involved to see who is actually responsible for paying those back taxes, which it turned out is technically the employer since they were the ones required to withhold the taxes. But in any case, it's a great point. You're not subject to that FICA and Medicare, which is a great tax savings while you're in the non-residency period. But just make sure you're communicating that information and checking your W-2 before and after to make sure your employer is doing the right thing on both sides of that exemption. If you have a question about your US tax position, moving abroad, expatriation, I'm happy to talk to you about it and personalize a plan for you. Reach out to us on my website and I'd be happy to set up a call.